Please stay tuned after the conclusion of the podcast for additional important information. Hi, everybody. Welcome to another edition of Accrued Interest, PIMCO's podcast dedicating to serving the financial advisor community and their clients. Today, we have a really special program that I can't wait to get to. My name's Greg Hall. I'm the head of wealth management here at PIMCO. My co-host for today is Cory McNamara. Cory hails originally, I think, from Cincinnati, Ohio. Do I have that right?
That's right.
But today you live in another prominent river town, Philadelphia, Pennsylvania, where you cover that market, and South New Jersey for us, right?
That's correct. A lot to celebrate lately.
Another big win for Philadelphia.
For sure.
Yeah. First the Super Bowl. Now you get to be on a podcast. Your parents must be so proud.
It just keeps going.
It just keeps going. Well, Cory here is, of course, here to represent the voice of the financial advisor and to represent his clients in that region. But let me get to our main event here. We're joined by Rich Clarida, who is a managing director and senior economic advisor here at PIMCO. Rich has a fine career of service, not just to PIMCO, but to our country as well, having served as vice chair of the Federal Reserve, multiple stints in the Treasury Department as an advisor to presidents on economic issues. And he leads our investment forum process here at PIMCO, which I'm going to ask him to speak about in a little while. But Rich, welcome, and thank you for joining us.
You bet. Looking forward to it.
All right. Well, I wanted to start a little bit just to ease our way into economic topics here, because there's a lot to talk about right now, and we're recording this on February 18th just to situate everybody. But Rich, maybe you could just give us a sense of your career path, the things that you've done, the experiences you've had, how you came to PIMCO, how you've managed to stay with us as long as you have.
Well, sure. I've been doing this a long time. So I grew up in the heartland, Illinois, downstate Illinois, a little coal mining town. I was an econ major in college and was really lucky. I knew what I wanted to do. I wanted to be an economist and economics professor. So I did my graduate work at Harvard, and then really had a 20-year career as an economics professor, mostly at Columbia. I did have a chance to work in Washington, D.C. during the Reagan administration on the Council of Economic Advisors, and I sort of got the bug to want to come back to public service. And then had an opportunity, as you mentioned, to serve as Assistant Secretary of the Treasury 20 years ago in the George W. Bush administration. And then a couple of years after that, got a phone call to interview for a position at PIMCO. And that was now 19 years ago. And so I've been at PIMCO. I was at PIMCO from 2006 till 2018, went to the Fed as vice chair, and then returned about a year or so after my term finished up at the Fed. I've been back since then.
So you spent 12 years at PIMCO, took a quick break to be vice chair of the Fed for 4 years, and then came back.
Exactly.
Right. And you're still a professor at Columbia, right?
And I still teach a course up at Columbia.
All right. So you've managed to keep that vein of education in running throughout. And of course, that'll be helpful, I think, for us today as we look to impart some wisdom to listeners. Another area that I did want to spend a little bit of time on here up front, you run our Secular Investment Forum each year. And it's a very special tradition of PIMCO's. It's how the whole firm comes together to formulate an investment viewpoint over a relatively long time frame. I thought maybe you could go into that tradition a little bit, talk about how we do that, and what you think maybe sets it apart from other decision-making processes you've been involved in.
It is. It's really been an integral part of PIMCO's investment process now for more than 40 years. It was actually the brainchild of our founder, Bill Gross. And the basic idea is a lot of firms and a lot of our competitors are trying to get an edge over the next 6 months, the next 12 months. And Bill's idea was, let's carve out 1 week a year where we bring together all the investment professionals from around the world and try to look ahead 3 to 5 years to identify trends or changes in economic policy, in markets, in the global economy. and try to identify those trends before other folks do, and also try to identify trends that have been playing out that may unwind during that time. It's an all of PIMCO effort, and it draws on not only portfolio management but client-facing and product. And then it's a big part of the way we think about interfacing with our clients and also thinking about ways we want to grow and improve. So I'm really proud to be part of it. It's something I started doing 10 years ago, and I was really thrilled when I came back and had an opportunity to continue.
Yeah, I think it's very special, particularly when you're sitting in our big meeting room in Newport Beach at our headquarters, when you see an associate or a vice president raise their hand and maybe contradict a senior economist, a former central bank head, a former prime minister on a given point, and then the debate that ensues, because it's really a no holds barred kind of environment.
Yeah.
Cory, have you ever piped up in forum and reprimanded a senior economist?
No, I haven't had the opportunity just yet, but I'm looking forward to that.
This would be your chance this year.
Maybe this,
maybe on the podcast.
I am curious though. Is this in the secular process, which is annual? Are you thinking about sort of curating the outside speakers that come in throughout the course of the year, or like is it in the 2 months leading up to it's I have to get going now? How do you think about sort of lining up the docket?
I'm dating myself now, but in my youth I used to watch the Macy's Thanksgiving Day parade on Thanksgiving Day. Obviously in New York you can see it yourself, but and what they always say at every Macy's parade, or at least in those days they said was, tomorrow we're going to start planning for next year's parade. And it's not quite that way, but usually the forum's in May, and then May, June, and July are very intense. There's a big rollout. I go to Asia for 2 weeks. I go to Europe for a week. I go around the U.S., and the whole PIMCO universe is out traveling, seeing clients. Then take some time off in August, but usually really coming back after Labor Day in September, I'm really starting to try to put together the program. So the program's been mostly put to bed now since December.
Well in advance.
Yeah. Any hints on upcoming topics for this discussion?
Well, obviously, we're going to be talking about U.S. Trade policy, geoeconomics, global outlook. There's certainly enough to keep us busy for sure. And we'll have some very special speakers. We'll do the big reveal on that probably at the end of March. So I don't want to jinx it. Yeah.
All right, we'll talk about that in a future episode. Well, look, I think that's actually a pretty great segue to what I would imagine is on the minds of a lot of financial advisors as they listen to us and as they talk to their clients on a daily basis. And I think with you here with us, Rich, we got to go straight, I think, to inflation, the Fed, where we are, what they're thinking. You've been on a number of podcasts recently, which I forgive you for sitting in other venues and adding your sage advice. But what's amazing about the current environment is just the data is coming so fast and furious. And so, my fear that anything we could cover today might be dated based on what you did a couple of weeks ago, it's unfounded. Just in the last week, we've had a relatively hot CPI print, a relatively cool retail sales piece of data. So, open-ended question for you is where do you think we are in the cycle at this point? Are we getting any clarity on the path of inflation?
Sure. Well, I think context here is relevant. So 3 years ago, we were not in a good place. Inflation was running at 9%. The Fed was behind the curve. It wasn't at all obvious if the Fed would be able to get inflation down to 2%. It wasn't obvious how high rates would have to go. And it wasn't obvious what the collateral damage would be, recession, unemployment. And so you fast forward to today with that context, inflation has declined substantially. It's running about 2.5%. We not only avoided a recession, we had 2 consecutive above-trend growth years, obviously strong gains in productivity, strong gains in consumption. And so all in, I think going into 2025 is a very positive set of initial conditions. That said, inflation is proving to be a little bit more sticky and stubborn than the Fed hoped. A year ago, the Fed was thinking by now inflation would be running, its preferred measure would be running under 2.5, and the core measure of its preferred index is running about 2.8. And moreover, there's additional uncertainty. There's always uncertainty. I learned firsthand during my 4 years as vice chair. There are always plenty of things to worry about when you're a Fed official, but there's an especially long list right now. So we have potentially dramatic changes in trade policy and tax policy, in regulation, deregulation, and immigration. And so the Fed is right now has cut rates. They cut rates 1 percentage point last year. At the most recent meeting in January, they were on hold. As I've been saying really for some time to our clients, really since December, I think Jay Powell and the Fed bought optionality in December. If they want to be on the sidelines all year, they can be. They're going to be data dependent. And so I think the PIMCO baseline outlook, so sort of the center of gravity of our thinking, is growth slows down a bit, maybe to roughly a trend pace of 2%. Inflation continues to decline, but the pace of decline will depend in part on what we see in terms of tariffs. And another thing we're also focused on, maybe I'll finish on this, is uncertainty itself can be a macroeconomic factor. So we talk about what does it mean to have a tax cut or a tariff. Okay, you can look at that, but there's also what about the uncertainty over the details of tax and tariff policy? That can also be a macro factor. It can be a headwind to growth. And so one of the things we try to do at PIMCO is instead of just focusing all of our attention on the baseline, we also like to look at other scenarios that may also play out. And we think by sticking to that, it helps to give us an edge and navigate through these sorts of environments.
Yeah, there's a lot there. I like the last thing you said. I think is really valuable, and it's come up in previous conversations we've had on the pod with Dan Iveson, our CIO, with Mark Seidner, another CIO here at PIMCO, just about the importance of having a framework, so that when the non-base case scenario happens, you've already thought out in advance kind of how you want to react. I have a bunch of stuff, but I wanted to maybe zoom out a little bit. I remember maybe November timeframe last year, you had you had a baseline view along with the rest of us here at PIMCO that not to use too simple a word, but the soft landing was kind of our base case, and I think you just articulated exactly that. Growth has remained solid, inflation has trended down towards levels that are 2 point something. But you raised the specter of sticky inflation, where it would just take longer and longer and longer. Do you think that's the zone that we're in now, or are you still, are we just delayed gratification on the soft landing at this point?
No, certainly it's easier to look backward. Certainly last year, in retrospect, inflation did prove to be stickier, than a lot of folks thought. In the context of still very, very resilient growth, we continue to have as a baseline, this soft landing scenario. I would also say, however, and I'm more free to say this now than I was as a Fed official, an inflation rate of 2.4, 2.3%, is essentially the same as a 2% inflation rate. And so I don't see the Powell Fed breaking a lot of grass or disrupting the economy, for that last 20 or 30 basis points if it meant raising rates. And so our view is really the way to think about the Fed outlook is if the data improves and inflation is less sticky, they'll cut. If inflation stays stuck in the 2 point something range, they'll just stay on hold. I do think that the hurdle for a hike is high. It's not insurmountable. But and certainly Fed speak itself, when they've been pressed on this in press conferences, Chair Powell was up on Capitol Hill last week for testimony. Whenever they're pressed on the sticky inflation scenario or even maybe the tariff scenario, they don't really talk about rate hikes. They just talk about staying on hold for longer. So I do think that's the relevant scenario right now.
And that's a good boundary to have in place as we think about upside, downside risks, especially in fixed income. Just,
certainly.
Yeah, base case that unlikely to go higher on the short end. We've said tariffs a couple of times, and Cory, I think you'll agree that's definitely top of mind. I think for a lot of advisors right now, really probably the whole country, given the attention that it's getting. One of the things that, and you just published a piece on this actually. It was in the FT. I think it's on our website. We can link to it in the show notes. But I have been surprised at the degree to which the market actually seems to react with the kind of ambivalence or uncertainty to tariff announcements that is probably warranted. There's a knee-jerk reaction that tariffs are just inflationary. Because they potentially increase prices. But it's a lot more nuanced than that. You'd be better than explaining it than me. But I'd just be maybe you could outline that nuance for our listeners, and then we can talk about the impacts.
Yeah, I think I'm glad you asked that, Greg, because I actually think there are two dimensions to the nuance. So the first nuance, and the term I've used when I talk about this, is markets are trying to figure out, are tariffs, a bargaining chip or a battering ram? And my interpretation is right now markets are very much in the bargaining chip mindset, not the battering ram. Now, of course, it can be both, but to simplify, Trump is the art of the deal. That threatening tariffs is a way to get what he wants on other policies. And but then there's the other element of the nuance. Well, suppose we do get tariffs. We already have tariffs on China that are in place. Steel tariffs have been announced. Reciprocal tariffs, which basically means that we'll charge a tariff at the same rate a country charges on us, have been also announced or signaled. And then there's uncertainty over the details, and in particular from the Fed's point of view, and Governor Waller spoke about this just yesterday, or at least I saw the remarks yesterday, is how would the Fed react to the reality of tariffs that pushed up import prices? And what Chris said, and this is also consistent with the briefings that I got as a Fed governor in 2018 during Trump 1.0, is that the initial inclination would be to look through a one-time increase in import prices from tariffs, but with an important caveat or qualifier. So long as the Fed judged that inflation expectations remained anchored. Back in Trump 1.0, we did have tariffs. Now, the initial conditions were different. Inflation was below 2%, not above 2%. And if anything, in that cycle, as I pointed out in the PIMCO.com article, is that what the U.S. saw was that the trade policy uncertainty effect that was depressing activity and investment actually outweighed the tariff effect. So inflation was falling in Trump 1.0 during the tariffs, and so we cut rates.
So that's actually really If I can stop you. So the uncertainty in corporate America and making CapEx decisions,
hiring decisions,
and planning for the next year was such that you saw growth slow down.
Oh yeah.
That was deflationary and outweighed the inflationary impact of the tariffs.
For sure.
But now our initial conditions are different. Everybody in the country has inflation on the tip of their tongue.
Oh yeah.
Sentiment might be a little bit more prone to extrapolate a tariff price adjustment into long-term expectation.
Yeah, and just to cut to the chase from the Fed's point of view. And I was, confess to our listeners, I was a charter member of Team Transitory, and so the challenge in a scenario where you get big tariff increases that push up the measured inflation rate materially, if even for a short period, the risk if you're the Fed is you explain that on TV or in a press conference by saying, well, no problem, it's transitory. And of course, that didn't work out so well the last time. And so that's why I do think, and Chair Powell has been right in the press conferences to really highlight that they're not taking well-anchored inflation expectations for granted. And so I think that's why this is potentially a somewhat different calculus on the part of the Fed than when I was there several years ago.
Is there a sense in which the Fed almost can't move? And I'm going to struggle to articulate this, but to use your analogy, nobody knows if it's bargaining chip or battering ram.
Yeah.
And that, of course, if it is a strategy, that's the power of that strategy is you don't get to know in advance. The strategy breaks down if you know it's a bargaining chip. And so if you are Chairman Powell and you're trying to determine the appropriate policy response, and you don't know if historically significant tariffs are about to be put in place, the degree to which you would feel comfortable cutting, even if the data suggested that were a possibility, it must be somewhat less. It must induce uncertainty, if you will, in the Fed itself in terms of how they react.
And that you're exactly right. And I think it's compounded by the fact that monetary policy operates with long lags. And so, a rate cut that could look very sensible in May could be feeding through the economy at a point when tariffs are already coming in place. And so I think that, and this is a case in which I think the trade policy and fiscal and immigration policy uncertainty is, when I was at the Fed, it was showing up in the macro data and we responded to it. Now I think it's also potentially just a factor that is entering the Fed calculus itself. Now, again, there are scenarios where they'll cut rates and they'll look through it. I think they've said if we have a pronounced weakening in the labor market, they'll react. But I think absent a weakening in the labor market, it does mean that the hurdle in terms of improvement in disinflation that has to be crossed before they consider a rate cut is probably higher now than it would have been absent this uncertainty about tariffs. Now, of course, there's also a cost in the other direction. If you say, forget the uncertainty, we think there are going to be tariffs, I'm going to raise rates, or I'm going to take rate cuts off the table and say we're done, and then you don't get the tariffs, then the economy goes south because you tightened ahead of something that didn't happen. So it's definitely a relevant consideration now.
Yeah, no, it's a tricky time to be at the Fed. Maybe you feel like you want to be back there. Maybe you're happy you're not.
I love doing what I'm doing.
Okay. So. Rich, does it feel like that the March meeting is a live meeting, or is there still too much to tell between now and then?
I'll go on a limb here. I don't think it's a live meeting in terms of a rate cut.
Okay.
I think if there's any inkling they might cut in March, that got taken off the table with the CPI number that we got. I think it is a live meeting in terms of what they signal for the rest of the year, because in March we'll get a new set of economic projections, we'll get a new set of dots, so interest rate projections, and so it will be a consequential meeting, even though I don't expect them to do anything on rates.
Well, that's good, because I know for certain the clients that we serve and that we're meeting with on a daily basis, one of the primary questions is certainly where is the Fed funds going? When is it a live meeting? What's the ultimate trajectory this year? How many do you have sort of baked in? And that's a primary question that gets asked.
Let's just maybe put some context on that. So the last time the Fed formally updated rate projections was at the December meeting. And the center of gravity on the committee then was 2 rate cuts this year. That still makes sense to us as a baseline, although we certainly see a very plausible scenario where they're on hold. But importantly, at that December meeting, 18 of the 19 participants at the meeting thought at least one rate cut would be appropriate. And even now, some of the more hawkish members of the committee are still talking about rate cuts, just wanting to hold off making that decision until more data comes in. So that still seems like the baseline to us. I think importantly, however, we are in a much different position now in terms of the yield curve than we have been in the last couple of years, and now there's a positive slope in the curve. So investors who take on duration in their portfolios are actually earning some carry over and above, money market rates, which was not the case for 2 years until recently. So
good point.
Yeah, no, and investors, you can see in the fund flow data, they're taking advantage of that, and fixed income flows have been strong year to date, and the short-term strategies that go out 1, 2, 3 years have been very, very strong. So advisors get that, and they're taking advantage of it. With yields where they are, and with value kind of returning in fixed income, and I think most crucially, with your viewpoint about there being a really high hurdle to raising rates at this point, the exact timing when the Fed cuts and when inflation is brought under control within reason is kind of immaterial to the investment decision.
Yeah, well, especially now that the curve has a positive slope.
Yeah.
I think that was a key inflection point last November. The other thing I'll say as well is, an important reason why investors do allocate to fixed income is they earn that coupon, they earn the alpha that a PIMCO can generate, but then in an economic downturn, they earn the price appreciation when yields fall. And one important difference between today and when I served on the Fed is in the last cycle, when we hiked rates, we got the funds rate up to 2.5% and 10-year Treasury yields were 3%. Well, now 10-year Treasury yields are in the 4.5% range. The funds rate is around 4.5%. So the Fed has a lot of room to cut in the next downturn, which means there's a lot of room for bond prices to go up in a recession scenario. So if you will, the hedging value of quality fixed income in an investor's portfolio now is much more valuable than it was 6 or 7 years ago, just because there's more traditional policy space available.
Can we open that up just a little bit if we could? Because I think there's been a big reversal regarding the amount of cuts that were sort of priced into the market and now what is sort of baked in over the next decade even. It's much less, right? Could you sort of expand on that there's maybe some benefits to owning fixed income in this environment?
Well, exactly. So there's how much room does the Fed have to cut? And so that's, since the Fed has more or less said it's not going to go negative like the ECB and BOJ did, then that means essentially the room to cut is the level of federal funds rate, so around 4.5% right now. The second issue is how many cuts are priced in. And in September, after the September meeting, which was the first cut in this cycle, and it was 50 basis points, the markets were pricing in, a destination for the funds rate of under 3%. That number now is just a touch below 4%. So there's not only is the amount of space larger than it was before, but the amount of cuts priced in is actually even much less than it was 5 or 6 months ago. So again, that's an opportunity for an investor in a fixed income portfolio. You always want to be positioned well when things happen that aren't priced in. So.
Yeah, no, it's funny. We can follow this thread because I do think it's interesting. It wasn't that long ago that we were talking about an economy that could become fragile where the Fed didn't have any room really at all to cut any further. And we're in a very different position today. Other long-term concerns. So moving away from the tactical, I think we've talked about kind of the year ahead, and I think it's pretty clear where your head is on that, Rich. Let's talk about some longer-term issues. So, Rich, maybe give us a couple of minutes on spending and what you think that means for the yield curve over time.
Yeah, so there are very few things that people in Washington agree on, but one thing they do agree on is that the U.S. is on an unsustainable fiscal path. Budget deficits of 6% of GDP and a booming economy, debt to GDP ratio north of 100%. And one of the arguments we've made at PIMCO now, really going back a year, in fact, I published a piece on PIMCO.com on this in April of last year, is the markets are already starting to sniff this out in the sense that there's now pretty clearly evidence of a positive term premium built into longer maturity treasuries and corporates. And a term premium is simply the extra reward an investor can expect to earn by taking on interest rate or duration risk. The term premium was basically squeezed out of the U.S. government bond market and even the broader market. For the decade before the pandemic, we were in a world of very, very low rates. We were in a world of negative rates in Europe. The Fed was doing quantitative easing. And so the world is now in some ways returning back to more of an older normal where there is this positive return. And we think a lot of, not all of it, but a lot of that is driven by the U.S. fiscal outlook. And bad news about fiscal policy does tend to steepen up the yield curve. We're seeing that in the data. Now, I should also say that the dollar continues to be the global reserve currency, and treasuries are far and away the preferred global collateral asset. And so, there's not going to be a buyer's strike. Someone's going to buy treasuries, but probably at a higher yield than they were willing to accept 5 or 6 years ago. We think that's largely in the current price. There's a reason why Treasury yields are 4.5 now and not 3 as they were 5 or 6 years ago. And so you have the opportunity, as I said, locking in those yields, and then on top of that, active management, perhaps taking on some investment grade or mortgage spread. You can now easily get a high quality bond portfolio with a 6+% coupon. Inflation running in the 2s, that's historically a very, very attractive valuation.
And that's without any real cuts priced in on the horizon. So there's still potentially some coupon plus opportunities in the event that the Fed has to course correct a little bit quicker in the event of a policy misstep.
But you're not overly concerned about a buyer's strike, a UK Liz Truss sort of moment for the U.S. market.
I don't want to say it can't happen. Look, we had a taper tantrum back in 2013, now 12 years ago, just based upon some confusion about Fed policy. So you can get bond market sell-offs. I certainly don't want to say to our listeners we're not going to get.
Yeah.
We had one in the fall of 2023 here in the U.S. What I'm saying, though, is because the Treasury is the global reserve asset and the dollar is the global reserve currency, there's a level at which there will be a lot of buyers. Now, that's uncertain, but, one thing we have observed in the data is that when Treasury yields began to peak above 5% a year ago, they quickly began to move south. And so there is essentially yields in the U.S. now are very attractive to foreign investors.
One topic that hasn't been as, I haven't seen it in the headlines as often, I hear it around the halls of PIMCO more frequently, but it's quantitative tightening.
Yeah.
And the path there and the Fed's balance sheet. Any thoughts on what 2025 holds or a few years beyond?
Well, the Fed, Greg, as you correctly point out, the Fed has been doing quantitative tightening now going on 3 years. It commenced in May of 2022. Quantitative tightening is just reversing quantitative easing. So it's shrinking the balance sheet, not expanding the balance sheet. The Fed in this episode, as was the case before, is doing quantitative tightening passively. It's sometimes you'll see in the press or on Twitter the Fed's not selling anything. It's just letting the portfolio roll off organically and not reinvesting when that happens. The Fed has said something sort of vague along the lines of it will continue quantitative tightening until it reaches a, quote, ample level of bank reserves, but it hasn't defined what ample is. Very
clever of them.
Well, yeah, and I plead guilty to having done that myself back in 2019. But the Fed has given a pretty good indication that at the current pace of runoff, they'll start thinking about ending QT later this year. But there are scenarios where the QT continues into next year. So our bet is that sometime in the second half of this year, they'll bring QT to an end. But some possibility that it does continue for a while.
Yeah, and it's maybe just another aspect of not to simplify it too much, but reloading on tools they can use in the event of another downturn.
Yeah.
So that's another source of stability. Cory, anything else from your end that you think is high on the mind of your clients?
I think generally speaking, a lot of our clients are seeing the benefit of front-end rates coming down, as in the need to step out and benefit from extending duration. So I think just this idea of sort of a reacceleration of inflation that's sort of coming out of the tariff response or pro-business policies from Trump, this is all front and center for our clients, and ultimately how they convey it over to their end clients to have them feel more comfortable with taking more positions in maybe fixed income or just further out the curve.
Yeah, I'm curious, Rich, just maybe as a final thought. You observe the policymakers, you observe the central bank, and you observe the markets. What do you think of the market's reactions to all of the data and the news that we've gotten on the macro economy?
I think broadly fair. I think, for example, we can always talk about the Mag 7 or whatever, but the reality is if you just look at the bread and butter of the productivity statistics, we've had a run of data in the productivity of the economy, really even before the AI story starts to show up in the data. That's quite positive. We have more or less, we're on the verge, if not having achieved a soft landing. And so there are a lot of things, a lot of positive developments. And then if you expand the sort of domain globally, the U.S. exceptionalism theme is quite relevant, and it's relevant to both fixed income and equity markets. There's a global appetite. So I would say broadly fair. There are always going to be pockets, and at some point there'll be another pets.com where we can look back and say what were folks thinking. But no, I'd say broadly fair. But I would also say, if you look at historical evaluations, fixed income now looks very, very attractive compared to many other alternatives. Simply, so long as you're in a world where inflation is going to be in the twos and central banks have their credibility, valuations are relevant. They're not everything in markets, but valuations are relevant, and they're very, very compelling now for fixed income, that's for sure.
Well, I think that's a great note for us to end on, and actually, that exact note is one that may be the subject of a coming podcast, because a couple of our colleagues have just are working on a paper on that exact topic, relative valuations between equities and fixed income. So we may feature them as a special edition of the podcast in the coming week or so. If that happens, or if it doesn't, we will definitely be back in March to talk to our portfolio manager, Jerome Schneider, about short-term solutions and enhanced cash opportunities, given the theme of the day, stepping gingerly out onto the yield curve to take advantage of that positive slope. But thank you all for listening. Thank you for joining us. I think Rich gave us a terrific, top-down view of where he thinks the world is over the next 12 months, not to put words in your mouth, Rich, but relatively, we think, bounded to the upside in terms of rate increases, maybe bounded to the downside as data comes through, lots of uncertainty, lots of opportunities for active managers to take advantage of markets. And we think, similar to previous podcasts we've had with Dan and others, an opportunity-rich environment for the fixed income investor. With that, thank you, Cory, for joining us from the great city of Philadelphia.
Thank you,
and Rich.
Cory.
Yeah, thank you.
Can't thank you enough. Thank you very much.
My pleasure. Enjoyed it. Thank you.
All right, we'll do it again.
Talk soon.
As always, please visit us at PIMCO.com. If you identify yourself as a financial advisor, you'll be taken to Advisor Forum, which is our destination for advisors who are looking to help their clients with timely and impactful information about markets and investment opportunities. For now, I'm Greg Hall, Head of Wealth Management at PIMCO. Thanks so much for listening.
The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable, but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal pages/podcast disclosures.